It's Fed week and jobs report this week. What could go wrong? We're going to talk about it today. Welcome to SRT Live. I am your host, Sean, with the Sean Richard Mortgage team here at Guaranteed Rate. Thank you so much for joining me today. And boy, oh boy, do we have a blockbuster of a week ahead of us. We've got a slew of economic and real estate data just in the rear view from the end of last week. And then we've got some big hitters as far as market moving information this week. I'm going to break it all down for you, and we're going to end this session with a what does it all mean? So let's get started and jump into week in review. So last week, we also got a slew of economic data. Let's go ahead and start with our weekly jobless claims. And so this measures initial and continuing jobless claims, essentially unemployment claims. Initial is individuals filing for unemployment for the first time. Continuing claims is going to be those individuals that are renewing their unemployment benefits. This is a week over week number. So initial claims came in below expectations. Market analysts expected 205,000 jobless claims or unemployment claims. Came in all the way down at 186,000. Now, this is even further below the 195,000 that we got the week before. This is a little perplexing because we're seeing in the media, in the news, companies laying off workers. And so where are those workers going? What are they doing? Are they not filing for unemployment? Are these primarily part-time workers? Are these workers that have multiple jobs that are not going back to find an additional job? This is some of the questions that we need to be asking, because we're seeing these week over week numbers decline, but we're hearing in the media the exact opposite. We're seeing in the news. So we're going to watch these for continuing trends. Continuing claims actually rose from the previous reading of 1.65 million up to 1.675 million. So we saw about a 20,000 job continuing claim increase there. We also got the initial reading on GDP for the fourth quarter. Now, there's 3 readings on GDP. So once the fourth quarter ended, we get January, February, and then the final reading in March. We got the first reading, came in at growth for the fourth quarter at 2.9%. Now, this was above expectations of 2.6%. So we're also seeing some moderate growth in the economy in the form of GDP. Where is that going to lead us into are we heading into recession, or are we going to skate by without falling into a deep recession? GDP is going to be one of the keys to that equation. We also got new home sales. Now, this isn't as market indicating as existing home sales, which makes up 90% of the housing market, but new home sales does give us a pulse on the status of new builds and builders as we move forward. New home sales came in right about expectations, 616,000 annualized pace. This is in line with the expectations of 617,000. But this is above the previous reading of an annualized pace of 602,000. So we saw that tick up just a little bit on the new home front. We also got inflation last week. Now, we got PCE, which is personal consumption expenditure. And this is the Fed's favorite measure of inflation. The Fed actually focuses on core PCE, which strips out food and energy. The Fed feels like they don't have a whole lot of their monetary policy doesn't have a significant impact on the prices of food and energy. There's a lot of outside factors that influence that versus their monetary policy. So headline numbers, including food and energy, month over month, we came in at a positive 0.1% reading. So inflation up 0.1%, 1/10 month over month. This was a hair above expectations of 0, of flat. And this is right in line with the previous reading of 0.1%. Now, this put as a year over year number us at 5% on year over year inflation. So we're seeing that come down pretty steadily. The previous month's reading, and again, we're talking about the December's numbers. So November's reading was up at 5.5%. So we saw a nice healthy 0.5% decline in year over year inflationary numbers. Now, because I referenced core inflation with PCE, the core inflation year over year number came in at 4.4% against the Fed's target inflation of 2%. So they're working on getting that down to 2%. That's what these Fed funds increases, these rate hikes have been all about. And we're seeing inflation move downwards. That's exactly what we want to see. Now, we also got the pending home sales index from the National Association of Realtors last week. And this is a great indicator of what we could see in existing home sales on the next report, on the subsequent report. So pending home sales actually came in up 2.5% month over month. And this is a big deal because market analysts were expecting a 1% decline. And we had a 4% decline last month on this same reading. So is this an indicator that we're starting to see the housing market turn around? Now, we always have seasonality in the housing market. So November, December, January, we tend to see the housing market slow down. But remember, this report is for the month of December. So we're seeing a pickup by 2.5% month over month. Even though we're down year over year, that's a great indicator at where the housing market could head into 2023. Now, this is important information because this is the first time that the pending home sales index has increased since May of 2022. So it's been a healthy number of months, and we're finally starting to see this turn around. We want to see if this is a trend by watching the same report next month. Now, this is pretty interesting as well because this report is broken into regions across the country, and the region that we're in here in the DFW Metroplex had the second largest increase. We were actually at 6.1% increase month over month for the region that we are in here in DFW. So again, we're seeing some pretty strong turnaround in housing here in the South. So we're going to keep an eye on this as we continue forward. So that wraps up the week in review. Now, we've already started the week off with a bit of a bang. We got two home appreciation reports this today. Actually, we got the FHFA home price index, and these were month over month numbers that I'm going to focus on. But month over month, we saw that nationally home prices declined by 0.1%. So just a hint there. The expectation was that home prices were going to increase by about 0.8%. Personally, I think that expectation was a little bit overzealous. And this negative 0.1%, somewhat in line with last month's reading of 0 flat. So we've seen home prices really stabilize, and in some cases they've come down, but really just a little bit. If you were to annualize this, we're talking about home prices coming down 1.5% year over year. This is in contrast to the 10, 15, 20, 30% appreciation levels that we've seen over the last several years in various areas of the country. So we were due for a little bit of a pullback, but I would say definitely not the crash that some people or even the media is talking about. Now, we also got the Case-Shiller home price index, and this one I'm going to focus on year over year numbers. And we came in at 6.8% appreciation year over year. So home prices 6.8% higher than they were last year. This has been steadily declining, and we can see that from last month's reading of 8.7%. So this number was up around 20% several months ago, and we're seeing it slowly work its way down. And that's to be expected as we see the housing market soften and we see home prices stabilize and in some cases come down just a little bit. So something that we want to keep an eye on. One more note on the FHFA home price index is the West South Central region, which is again where we are in Texas, actually had a 0.3% increase on home prices month over month. So although there may be some areas of the country that are seeing a little bit of a decline, here in Texas and this region, we are not seeing that, and we're starting to see home prices tick back up ever so slightly. So we're going to watch that going forward. All right, so what are we looking for the rest of this week? We've got some pretty incredible market moving numbers that are coming out. Starting with tomorrow, we've got the ADP payroll report. And that has proven to be potentially a much more accurate indicator of what's going on in the jobs market versus the kind of rudimentary calculation that they use for the BLS jobs report. But ADP comes out tomorrow. We also get the JOLTS report, which measures job openings across the country. And this is important because it gives us an idea of what employers are doing. Are the number of job openings declining? Are we seeing a tightening labor market, a loosening labor market based on that metric? We're also getting the Fed rate decision. So the Fed is in their meeting today and tomorrow. We're going to get the Fed interest rate decision. The expectation is that we're going to see a 0.25% increase on the Fed funds rate. Remember, this is short-term lending rates. This does not have a direct impact on mortgage rates. And then we're also going to hear Jerome Powell, Jay Powell, speak after the Fed meeting. So we're going to see what he says. Everything that he says, all the words that come out of his mouth have the potential to move the markets. And so we want to pay close attention to what his outlook is going forward and what the Fed intends to do. That's all on Wednesday. Thursday, we get the ECB rate decision. So this is the European Central Bank rate decision. And this is the equivalent of the Fed decision. So we want to keep an eye on that because ultimately we are a global economy, and what happens overseas impacts our economy here in the US, including the housing market. We also get jobless claims or unemployment claims as we do every Thursday. And then we end the week with a bang with the BLS, Board of Labor and Statistics jobs report, and we end the unemployment rate. So that's going to finish off with some pretty impactful market moving data. I believe the expectation is that the market's looking for 188,000 new job creations. So if we miss significantly or blow by that significantly, that could have a pretty big impact on the market. So let's break this down into layman's terms. So what does this all mean? So first and foremost, let's talk about home prices. Home prices are declining nationally, but we are starting to see an increase again in certain regions. As I mentioned, South Central region where we are in Texas, we're starting to see a little bit of an increase. And as we continue to see mortgage rates decline and consumers feel more confident about the economy, demand will come back and we're going to see that accelerate home prices. Now, inflation is the other piece of this puzzle. Again, we got PCE, personal consumption expenditure. And as inflation continues to decline at a macro or national level, we're going to see that slowly trickle down into consumer prices and ultimately bring back affordability of goods. As that inflation declines, we're going to continue to see mortgage rates decline as well. Inflation is the enemy of mortgage rates. So as inflation comes down, mortgage rates will come down as well. And then lastly, we're going to look at home sales. Home sales are starting to turn around. We saw, the 2.5% increase on pending home sales, which could lead us to a higher level of existing home sales on next month's report. Many sideline buyers are starting to get back into the market. And as demand picks up, we're going to see home prices increase and we're going to see the pace of sales increase as well. The big hurdle here is supply. Ultimately, there's nothing on the horizon that's going to have a significant impact on supply. Home builders are building at a little bit slower pace due to potential recessionary concerns. And as we see buyers come back in the market, some of them will be sellers, but not all of them. So we're going to have a higher amount of demand come back than we will supply. This is going to keep inventories levels low, and we're going to see a skewed supply and demand, maybe not as skewed as we saw the last couple of summers where we saw a frenzy in the real estate market. But I do think that we're going to see a significantly more competitive market than we have right now. I said it last week and I'll say it again. I believe that right now is the best time for home buyers in the last 18 months. And it very well may be the best time for home buyers in the next 18 months as well. Only time will tell, but that is how it all breaks down. So thank you so much for joining me on this episode of SRT Live. If you are checking us out in our private Facebook group, thank you so much for being part of our amazing community. If you're watching on YouTube, make sure to hit that subscribe button so that way you get the latest real estate and economic data at the tip of your fingers. All right. Well, again, thank you so much. For me, Sean, with the Sean Richard Mortgage Team, have an incredible rest of your week. Take care.